Gold is sitting at $4,938 today, February 18, 2026, and five of Wall Street's biggest names, J.P. Morgan, Goldman Sachs, Deutsche Bank, and Yardeni Research just put their reputations on the line with targets ranging from $5,400 to $6,300 by year-end. One of them thinks $6,000 is actually conservative. The question is, do they know something you don't? Welcome to Capital Anchor. I cut through the noise and show you what is actually happening in markets while everyone else is distracted. If you are new here, subscribe right now, because what I am about to show you will completely change how you understand where gold is going and, more importantly, why. Let's start with what just happened. Gold began 2025 at approximately $2,600 per ounce. By October 2025, it crossed $4,000 for the first time in history. That was a 55% surge in under 10 months. Then it kept going. In January 2026, gold hit a new all-time high of $4,568. By late January, it had pushed above $5,300. By February 11, 2026, it was trading at $5,072. As of today, February 18, 2026, gold is pulling back slightly to $4,938. But here is the number that should stop you cold. Gold has gained more than $2,100 per ounce in just 12 months. That is not a rally. That is a structural shift. Now let's talk about what the big players are actually saying. Yardeni Research has a $6,000 price target for 2026. That is the boldest call on Wall Street right now. J.P. Morgan, not exactly known for being reckless, just revised its forecast upward to $6,300 by year-end, nearly doubling gold from where it started 2025. Deutsche Bank set its target at $6,000. UBS is at $6,200. As of January 26, 2026, upgraded its forecast to $6,000, calling it a potentially conservative estimate. Goldman Sachs raised its December 2026 target from $4,900 to $5,400. Morgan Stanley's bull case sits at $5,700. Think about this. These are not fringe analysts or newsletter writers. These are the largest financial institutions on the planet, and they are all pointing the same direction. But here is what most people watching this video have not processed yet. Gold is not rising because of fear alone. It is rising because of a structural repricing, one that is decades in the making. Here is the analogy that will make this click. Think of the global monetary system like a scale. On one side, you have paper currencies, dollars, euros, yuan. On the other side, you have hard assets like gold. For 40 years, that scale tilted hard toward paper. Central banks piled into U.S. treasuries. Dollars were the safe haven. Gold was an afterthought. But something cracked in 2022, and now the scale is tipping the other way slowly, permanently, and with enormous force. That crack was the freezing of Russia's $300 billion in foreign reserves after the Ukraine invasion. In one single decision, the U.S. government showed every central bank on earth that dollar-denominated reserves could be weaponized. That moment is called the sanction shock, and it changed everything about how countries think about storing wealth. Now let's get into the 3 reasons this gold run is different from anything we have seen before. Reason number 1, central banks are buying gold at a pace not seen in 50 years. In 2025, global central bank gold purchases totaled 863 tons. J.P. Morgan projects that number holds at approximately 585 tons per quarter in 2026. China's central bank extended its gold buying for the 15th consecutive month in January 2026. The People's Bank of China did not stop when prices hit $3,000. It did not stop at $4,000. It did not stop at $5,000. That tells you everything about what they believe is coming. Reason number 2, the US dollar is structurally weakening. Gold is priced in dollars. When the dollar loses value, gold priced in dollars goes up. But this is more than the usual currency cycle. Morgan Stanley projects the dollar could fall another 11% in 2026 alone, after it already dropped 10% in 2025. That is a 21% decline in 2 years. When the world's reserve currency loses a fifth of its value in 24 months, every asset priced in dollars gets repriced higher. Gold leads that repricing because it has no counterparty risk, it owes nothing to no government. Reason number 3. The Federal Reserve is losing credibility. In January 2026, federal prosecutors opened a criminal investigation into Fed Chair Jerome Powell. Subpoenas were issued to the Federal Reserve itself. President Trump has openly threatened to replace Powell. The moment markets began pricing in a politically compromised Fed, gold surged to $4,568 in a single session. Investors are not just hedging against inflation anymore, they are hedging against institutional collapse. Now here is the critical disconnect that most retail investors are missing entirely. While mainstream financial media spent all of 2025 telling you to buy tech stocks and trust the AI rally, central banks were doing the opposite of what they told their own citizens to do. The World Gold Council confirmed that 76% of central bank officials expect gold to make up a higher share of international reserves over the next 5 years. That is not a speculative bet, that is policy, and policy moves trillions, not billions of dollars. While retail investors were watching gold hit $2,600 and thinking I missed it, institutions were loading up at $3,000, at $3,500, at $4,000. At every price they said was too high, the big players were buying more. There is a phrase that the smart money lives by: they do not wait for permission from the media. They do not wait for the narrative to catch up. They position before the move and then they let the news explain the move after the fact. Right now, JP Morgan is positioned in gold. Goldman Sachs is positioned in gold. Deutsche Bank is positioned in gold. And they are all publishing $6,000 price targets, which means the clients reading those research notes are also positioning in gold. The question is not whether gold is going higher. 5 of the most powerful financial institutions on Earth, with access to data you and I will never see, are aligned on that answer. The real question is what comes next, and that is where things get genuinely complicated. Because there is a scenario playing out right now that almost nobody in financial media is explaining properly, and it involves a collision between Fed rate policy, the dollar's collapse timeline, and one specific technical trigger that could either ignite the next leg of this rally or cause a sharp correction before the big move. Now here is what most people completely miss because they are so focused on the price going up, they never stop to ask what happens when the same pattern played out before. Go back to the year 2001. Gold was trading at $271 per ounce. Nobody wanted it. Tech stocks were collapsing. The dollar was strong. The mainstream narrative said gold was a relic. Then the US invaded Afghanistan. Then Iraq. The national debt exploded. The Federal Reserve kept interest rates near zero for 4 years. And gold did something extraordinary. From $271 in 2001, gold climbed to $1,921 by September 2011. That is a 610% gain in 10 years, and here is the direct parallel to today. The drivers in 2001 were geopolitical instability, dollar weakness, and a Federal Reserve losing credibility. The drivers in 2026 are geopolitical instability, dollar weakness, and a Federal Reserve under criminal investigation. The pattern is not similar, it is identical. Gold pushed over the 5,000. Pillar 3. Total global mine production stands at only 3,672 tons annually. Trading economics demand is running at 5,002 tons. That is a structural supply deficit of over 1,300 tons per year. New mines take 10 to 15 years to develop. That gap does not close quickly. Pillar 4. The dollar is in a multi-year structural decline. The dollar sank to a 4-year low recently after President Trump said he is comfortable with the recent weakness in the dollar. Fortune when the President of the United States explicitly endorses a weaker dollar. That is not a temporary policy position. That is a signal to every central bank on Earth about where the dollar is heading. Now I want to go on the record. Screenshot this. By December 31, 2026, gold will trade at or above $5,800 per ounce. That is not the $6,300 that JP Morgan is calling for. It is not the $6,000 from Deutsche Bank or Yardeni Research. It is a conservative interpretation of where the structural forces point, factoring in the current pullback, the Shanghai liquidity vacuum, and the likely volatility around Federal Reserve leadership changes. If Kevin Warsh becomes Fed chair and pivots hawkish, that timeline may extend into Q1 2027, but the destination does not change. Now here are 3 scenarios with honest probabilities. Scenario 1. Gold reaches $5,800 to $6,300 by December 2026, probability 65%. This requires the dollar to continue weakening, central bank buying to hold near 850 tons, and no major deflationary shock. All 3 of these conditions are currently intact. Scenario 2. Gold consolidates between $4,500 and $5,200 for the remainder of 2026, probability 25%. This happens if the Federal Reserve surprises markets with a hawkish pivot, or if Kevin Warsh is confirmed as Fed chair and signals aggressive tightening. The gold price corrects but holds above structural support. Scenario 3. Gold breaks below $4,000 in a major liquidity event, probability 10%. This requires a 2013-style collapse in inflation expectations combined with a dramatic dollar surge and mass deleveraging. Possible, but the structural backdrop today is fundamentally different from 2013. Now let me give you practical guidance based on who you actually are. If you are holding physical gold right now, coins, bars, allocated accounts, you are in the strongest position. Do nothing. The supply deficit and central bank buying create a structural floor that paper traders do not have access to. Your only job is patience. If you are using leverage or actively trading gold futures, this is the most dangerous environment in years. By mid-January 2026, positioning in gold was at an 8-year high among retail investors. Light-finance crowded trades correct violently. Reduce your leverage. Tighten your stops. The trend is your friend until the margin call is not. If you are sitting on cash and watching from the sidelines, the February pullback is giving you an entry point that did not exist a month ago. Gold at $4,938 today is $662 cheaper than its January peak of $5,600. You do not need to chase highs, but waiting for gold to go back to $4,000 before you act is likely to mean waiting forever. If you bought near the top and are underwater right now, first, understand you are not in a crisis. You are in a correction within a structural bull market. Second, do not add to a losing position using leverage. If you bought physical gold, hold it. If you bought paper gold or leveraged ETFs near the peak, assess your cost basis against the 12-month outlook, not the 12-day chart. Here are 4 specific indicators to watch in the weeks ahead. Watch the DXY, the US dollar index. It is currently at 97.28. If it breaks below 95, gold gets a direct catalyst for the next leg higher. If it rebounds above 102, expect gold to face resistance. Watch the FOMC minutes releasing this week. Markets are pricing only a 10% chance of a rate cut on March 17th. Any language that shifts that probability higher will move gold immediately. Watch the Shanghai Gold Exchange reopening. The Shanghai Exchange is closed for Lunar New Year through February 23rd. Without the massive volume of the Shanghai session, gold is trading almost exclusively on U.S. macro data this week. EBC Financial Group, when Chinese buyers return on February 24th, physical demand comes back. Online, that date matters. Watch COMEX Gold Open Interest. When open interest rises alongside price, it signals new money entering bullish. When open interest falls alongside price, it signals capitulation, a potential bottom signal. Now let me tell you about the 3 types of people watching this video right now. The first type is panicking. They bought gold somewhere above $5,000. They are watching the price fall, and every red candle feels like the bull market is over. They are about to sell at the exact wrong moment. The second type is frozen. They have been watching gold for 2 years, telling themselves they will buy on the next dip. Now the dip is here and they still cannot pull the trigger. They will be saying the same thing at $6,000 that they said at $3,000. The third type is the one you want to be. They understand the mechanism. They understand the timeline. They are not reacting to the noise. They are watching the 4 indicators I just gave you. They are patient, and they are preparing while everyone else is distracted. Here is the truth about markets that nobody tells you. Every major wealth transfer in financial history followed the same pattern. The informed accumulated while the uninformed panicked or froze. The patient held while the impatient sold. The people who understood the mechanism profited while the people who only watched the price suffered. Gold is currently pulling back from a peak of $5,600 to $4,938. That pullback is real. The volatility is real. But the structural forces driving this bull market, central bank demand, dollar weakness, supply deficits, and de-dollarization, are more intact today than they were when gold was at $2,600 18 months ago. And that was the question the hook asked you at the beginning of this video. Do the big players know something you don't? Now you know the answer. Yes, and now, so do you. If this video changed how you see the gold market, hit like right now. It helps more people find this channel. Subscribe to Capital Anchor if you are not already here, and send this to one person in your life who is either panicking about their gold position or still waiting on the sidelines. Drop this in the comments right now. I'm the third type. Let me see how many of you are actually preparing while everyone else is distracted. This is not financial advice. Always do your own research and consult a qualified advisor before making investment decisions.